2 days ago, May 27, 2026, the United States Senate Finance Committee released an official statement confirming something that every single retiree in America needs to hear right now. According to that statement, 88% of seniors who receive Social Security benefits will pay zero federal income tax on those benefits this year. Zero. Not reduced, not partially exempt, zero. And here is the number that stopped me in my tracks when I read it. 34 million seniors already benefited from this during the most recent tax filing season, with an average household deduction of over $7,500. $7,500. That is not a small rounding error on a tax return. That is a car payment, a medical bill, a trip to see grandchildren, 6 months of groceries. And yet, despite 34 million seniors already claiming this benefit, I keep getting comments, I keep seeing posts, I keep hearing from people who had absolutely no idea this existed. Which means if you are watching this video right now, there is a real chance you are in the 12%, the millions of retirees who are still paying federal income taxes on their Social Security benefits, not because they do not qualify for relief, but because nobody sat down and explained to them exactly how this works, what the thresholds are, and what specific steps they need to take to make sure they are on the right side of that number. That is exactly what I'm going to do in the next 14 minutes. By the end of this video, you will know whether you are in the 88% or the 12%, and if you are in the 12%, you will know precisely what to do about it. Before I get into the numbers, I want to give you the full context of where this benefit came from, because understanding the origin of this deduction helps you understand why it exists, how long it will last, and most importantly, what it actually does and does not do for your retirement income. For years, President Trump campaigned on a promise that has resonated deeply with retirees across the country: no tax on Social Security. It was one of the most popular policy proposals he put forward, and it made intuitive sense to tens of millions of seniors who felt that paying taxes on a benefit they had spent decades contributing to through payroll taxes was a form of double taxation. When Trump took office and Congress got to work on the legislation that became known as the One Big Beautiful Bill, officially called the Working Families Tax Cuts Act, signed into law on July 4, 2025, that promise had to survive the political and procedural reality of getting through Congress. Because the bill was passed through a process called budget reconciliation, which requires a simple majority rather than 60 votes, Congress could not directly eliminate the federal tax on Social Security benefits. Doing so would have violated Senate rules around reconciliation. So instead, the law created something new, a brand new additional deduction specifically for seniors, designed to achieve the same practical outcome for the vast majority of retirees without technically changing the Social Security taxation rules themselves. The result is the Senior Bonus Deduction, and when combined with existing deductions, it eliminates Social Security taxes for 88% of recipients. Now let me give you the exact mechanics of this deduction because precision matters here, and I want you to leave this video knowing the specific numbers, not just the general concept. Under the Working Families Tax Cuts Act, every taxpayer who is age 65 or older may claim an additional $6,000 deduction on their federal tax return, on top of the standard deduction they were already entitled to, and on top of the existing seniors deduction that was already in the tax code. This $6,000 deduction is available regardless of whether you itemize your deductions or take the standard deduction, a distinction that matters enormously because in past years many deductions were only available to people who itemized, which excluded the majority of seniors who take the standard deduction. Not this one. Whether you itemize or not, if you are 65 or older, this $6,000 is yours to claim. For married couples where both spouses are 65 or older, each spouse can claim the deduction independently, bringing the total household benefit to $12,000 in additional deductions. And according to the Senate Finance Committee statement released this past Tuesday, the average senior household is claiming over $7,500, meaning many are claiming even more than the base $6,000 when you factor in the existing seniors deduction stacking on top. Here's where the math gets interesting and where a lot of people get confused about how a deduction translates into actual dollars in your pocket. A deduction does not reduce your tax bill dollar for dollar. What it does is reduce the income on which you are taxed. So the value of a $6,000 deduction depends entirely on what tax bracket you are in. If you are in the 12% federal income tax bracket, which is where a large portion of retirees fall, a $6,000 deduction reduces your tax bill by $720. If you are in the 22% bracket, that same deduction saves you $1,320. But the impact goes far beyond the direct math of deduction times tax rate. Here's the bigger picture. The IRS determines how much of your Social Security is taxable based on your combined income. Adjusted gross income plus tax-exempt interest plus 50% of your Social Security benefits. By reducing your adjusted gross income by $6,000 through this deduction, you may fall below the threshold at which your Social Security gets taxed in the first place. For single filers, the threshold where Social Security begins to be taxable is $25,000 in combined income. For married filing jointly, it is $32,000. If the $6,000 deduction pulls your combined income below those thresholds, not only do you save on the direct deduction, you also stop paying tax on your Social Security benefits entirely. That double effect is why 88% of seniors end up paying zero on their benefits, even though the tax law technically still exists. Now I need to tell you about the income limits because this is where a significant portion of retirees get tripped up and end up either claiming less than they should or assuming they do not qualify when they actually do. The $6,000 senior bonus deduction is not available at every income level. The IRS phases it out for higher earners using a very specific formula. Here is the exact rule according to the official Ways and Means Committee documentation. If you are a single filer, you receive the full $6,000 deduction if your modified adjusted gross income is $75,000 or below. For every $1,000 of income above that $75,000 threshold, your deduction is reduced by $60. The deduction phases out completely at $175,000 for single filers. For married couples filing jointly, the full deduction is available at $150,000 or below in modified adjusted gross income. The same $60 reduction per $1,000 applies above that, and the deduction phases out entirely at $250,000 for joint filers. The practical implication of this is that if you are a single retiree with a modified AGI of $80,000, just $5,000 above the threshold, your deduction is reduced by $300 from $6,000 to $5,700. That is still a significant benefit. And importantly, many retirees who assume they are over the threshold because of their gross income may actually be below it once legitimate deductions are applied. Let me walk through a concrete, real-world example because I find that numbers without context are almost meaningless, and I want you to be able to run this calculation for your own situation after this video. Let's take a 70-year-old single retiree. Her income comes from three sources: Social Security benefits of $22,000 per year, a small pension from a former employer of $18,000 per year, and required minimum distributions from her traditional IRA of $12,000 per year. Her total gross income is $52,000. To calculate her modified adjusted gross income, we start with the pension and the IRA distribution, $30,000 of fully taxable income. We then add 50% of her Social Security benefits, $11,000. Her combined income for Social Security taxation purposes is $41,000, which is above the $34,000 threshold at which 85% of Social Security benefits become taxable. That means before the new deduction, she is paying income tax on $18,700 of her Social Security benefits, nearly her entire benefit amount. Now add the new $6,000 senior bonus deduction on top of her standard deduction of $15,750 for a single senior filer. Her total deductions exceed $21,000. Her taxable income drops significantly, and depending on the exact calculations, the reduction in AGI may pull her combined income below a lower threshold, reducing how much of her Social Security is taxable. The savings in her case could easily exceed $1,000 in federal taxes annually. Now I want to address the 12%, the retirees who are still paying taxes on their Social Security benefits despite everything I have just described. Who are these people, and why are they still in the taxable category? There are several specific situations where a retiree may still owe taxes on Social Security even after claiming the full $6,000 deduction. The first is income level. If your modified adjusted gross income is significantly above the phase-out thresholds, above $175,000 for single filers or $250,000 for married filers, you receive none of the senior bonus deduction, and your Social Security remains taxable at the rates that have been in the tax code since 1984. The second situation is multiple income sources stacking on top of each other. Retirees who have large required minimum distributions, pension income, significant investment income, part-time employment wages, and rental income may find that even with the $6,000 deduction, their combined income remains well above the thresholds at which Social Security gets taxed. The third situation is retirees who simply did not claim the deduction on their 2025 tax return because they were not aware it existed. According to the Senate Finance Committee, 34 million seniors claimed it. But that means millions of eligible seniors potentially did not, leaving real money unclaimed. If you filed your 2025 return without claiming this deduction and you were eligible, you have the right to file an amended return using IRS Form 1040-X to claim what you are owed. This brings me to one of the most important practical questions of this entire video. What do you actually do if you realize you missed this deduction on your 2025 tax return? The answer is an amended return, and I want to walk you through exactly what that means, so it does not feel intimidating. Filing an amended return is more common than most people think. The IRS processes millions of them every year. The form you need is IRS Form 104-0-X, which is titled Amended U.S. Individual Income Tax Return. You can file it electronically in most cases, which speeds up processing significantly. On the 104-0-X, you will identify the line on your original return where the senior bonus deduction should have appeared, enter the corrected amount, and recalculate your taxable income and tax liability with the deduction included. The IRS will process the amended return, determine what additional refund you are owed, and either send you a check or apply the amount to any outstanding balance. The deadline for filing an amended return to claim a refund is generally 3 years from the original filing deadline for that tax year. So for your 2025 return, which was due in April 2026, you have until April 2029 to file an amended return and claim the deduction you missed. That is not a reason to delay. Every month you wait is money sitting with the IRS that belongs in your pocket. But it does mean the window is not closed just because tax season is over. I also want to spend time on the interaction between this deduction and Medicare IRMAA surcharges, because this is a connection that almost nobody in the retirement space is talking about, and it represents a significant secondary benefit of managing your income carefully in light of the senior bonus deduction. Medicare IRMAA stands for Income-Related Monthly Adjustment Amount. It is an additional premium surcharge that Medicare adds to Part B and Part D premiums for beneficiaries whose income exceeds certain thresholds. In 2026, the IRMAA surcharges begin for single filers with a modified adjusted gross income above $106,000 and for married couples above $212,000. Here's the critical detail. Medicare IRMAA is calculated using your tax return from 2 years prior. So your 2026 Medicare premiums are based on your 2024 income, and your 2027 Medicare premiums will be based on your 2025 income. This means that if your 2025 income, after claiming the $6,000 senior bonus deduction, falls below the IRMAA threshold, you may avoid a Medicare surcharge in 2027 that you would have otherwise owed. The surcharges range from several hundred to several $1,000s per year depending on your income bracket. A $6,000 deduction that drops your 2025 modified AGI from $112,000 to $106,000 does not just save you tax on the deduction itself, it potentially eliminates an IRMAA surcharge tier for all of 2027. That is a compounding benefit that most retirees and even many financial advisors fail to account for when evaluating the true value of this deduction. Now let me turn to the most powerful proactive strategy available to retirees who want to make sure they are in the 88% next year and every year through 2028 while the deduction remains in effect. The strategy is income management, specifically managing the timing, amount, and source of your withdrawals to keep your modified adjusted gross income below the thresholds that determine both the senior bonus deduction phase-out and the Social Security taxation thresholds. This is not a complicated concept, but it requires intentional action rather than passive acceptance of whatever income happens to flow into your return. The first step is to calculate your projected, modified, adjusted gross income for 2026 right now, in May, rather than discovering it in February of next year when your tax documents arrive. Add up your expected pension income, your required minimum distributions from IRAs and 401ks, your investment income from dividends and capital gains, any part-time employment wages, and 50% of your expected Social Security benefits for the year. Compare that total to the $75,000 threshold for single filers or $150,000 for married filers. If you are above the threshold, you have 7 months left in 2026 to take action, to reduce IRA withdrawals, to shift income into a following year where possible, to accelerate charitable contributions through a qualified charitable distribution, or to explore other legitimate income reduction strategies. 7 months is more than enough time to make meaningful adjustments if you start today. One of the most effective tools for managing income in relation to both the senior bonus deduction and the Social Security taxation thresholds is the qualified charitable distribution. And I want to go deeper on this strategy than I did in my last video because it is genuinely that important for retirees who are charitably inclined. A qualified charitable distribution, or QCD, allows any IRA account holder who is age 70 and a half or older to transfer money directly from their IRA to a qualifying charity without that distribution ever appearing in their adjusted gross income. In 2026, the maximum QCD is $111,000 per person per year. The power of the QCD in the context of the senior bonus deduction is this. If you need to take an IRA withdrawal this year, whether as part of your required minimum distribution or simply to fund living expenses, doing it as a QCD rather than a regular distribution keeps that money completely out of your modified adjusted gross income. A retiree who would otherwise be at $80,000 in modified AGI, $5,000 above the $75,000 phase-out threshold, can do a $5,000 QCD to their church or favorite charity instead of a regular IRA withdrawal, drop their MAGI back to exactly $75,000, restore their full $6,000 senior bonus deduction, save hundreds of dollars in taxes, and make a charitable contribution they were planning to make anyway. It is the same dollars going to the same cause. The tax outcome is dramatically different. I want to make sure I address one concern I know many of you have when you hear about tax strategies like the ones I have described in this video. The concern that this is somehow too aggressive, too complicated, or that the IRS will look at you sideways for using these rules. Let me be completely direct about this. Everything I have described in this video is explicitly written into federal law. The Senior Bonus Deduction was passed by Congress and signed by the President. The qualified charitable distribution has been in the tax code for years and is explicitly endorsed by the IRS in Publication 590-B. Managing the timing of your IRA withdrawals to stay below income thresholds is standard, completely legal tax planning that financial advisors recommend to their clients every single day. The IRS does not penalize you for following the law. They do not audit you for taking deductions you are legally entitled to. What the IRS penalizes is failing to take required distributions, filing incorrect returns, or claiming deductions you do not qualify for. Taking a deduction that Congress specifically created for you is not aggressive. It is exactly what the law was designed to encourage. The only retirees who should feel nervous about these strategies are those who are misapplying them, claiming the deduction when their income is above the phase-out range, for example, or doing a QCD without following the proper direct transfer rules. If you do it correctly, the IRS has no issue with any of it whatsoever. Let me now address the concern that many financially sophisticated viewers have raised about this deduction, that by reducing the taxation of Social Security benefits for 88% of seniors, the law may have an unintended consequence on the long-term solvency of the Social Security Trust Fund itself. This is a legitimate concern, and I want to address it honestly, rather than pretend it does not exist. Social Security gets funded through two main revenue streams: payroll taxes paid by current workers and employers, and the income taxes collected on Social Security benefits paid to retirees above certain income thresholds. When fewer retirees pay taxes on their benefits because of the expanded senior deduction, less revenue flows into the Social Security Trust Fund from that second source. Independent analysts, including researchers at the Center for Retirement Research at Boston College, have noted that this effect, while real, is smaller than the impact of eliminating Social Security taxation entirely, which was the original campaign promise, because the deduction approach preserves taxation for higher earners above the phase-out thresholds. The practical implication for retirees watching this video is not that you should avoid using the deduction. You should absolutely use it. It was written into law for you. But that you should factor potential future benefit adjustments into your long-term retirement planning and not assume that Social Security benefits will remain unchanged in perpetuity. The last thing I want to cover before giving you your action items is the state tax dimension of this deduction, because it is something that affects millions of retirees and is almost never discussed in videos about the Senior Bonus Deduction. The $6,000 deduction is a federal deduction. It reduces your federal taxable income. But your state tax return is a separate calculation, and states vary enormously in how they treat this deduction and Social Security income generally. As of 2026, 8 states still tax Social Security benefits to some degree: Colorado, Connecticut, Minnesota, Montana, New Mexico, Rhode Island, Utah, and Vermont. In these states, even if the federal senior bonus deduction eliminates your federal tax on Social Security, you may still owe state income tax on a portion of your benefits. On the other end of the spectrum, states like Florida, Texas, Nevada, Washington, Wyoming, South Dakota, Alaska, and Tennessee have no state income tax at all, making the entire question of state Social Security taxation irrelevant for residents there. For the majority of states in the middle, the treatment varies. Some automatically adopt federal deductions, including the Senior Bonus Deduction, through conformity provisions, while others use their own rules and may not recognize the federal deduction at all. Before you assume your state return reflects the same benefit as your federal return, specifically ask your tax preparer how your state handles the Senior Bonus Deduction and Social Security income. Here is what I want you to do right now, today, not next month, based on everything in this video. Step 1. Pull out your 2025 federal tax return if you have filed it and look at the deduction section. Find where the senior bonus deduction should have been claimed. If it is not there and you are 65 or older, call your tax preparer and ask specifically why it was not included. If you filed it yourself, consider whether you used tax software that automatically included it. Step 2. If the deduction was missing from your 2025 return and you were eligible based on your income, start the process of filing an amended return using IRS Form 1040-X. Step 3. Calculate your projected 2026 modified adjusted gross income right now using the method I described. Add pension, IRA distributions, investment income, wages, and 50% of Social Security. Compare it to $75,000 for single filers and $150,000 for joint filers. Step 4. If you are above those thresholds, identify what actions you can take before December 31st of 2026 to reduce your MAGI, qualified charitable distributions, reduced IRA withdrawals, income deferral strategies. Step 5. Subscribe to this channel because next week I am covering the exact Roth conversion strategy that allows you to use this 3-year deduction window, 2025 through 2028, to permanently restructure your retirement income in a way that protects you from taxes long after this deduction expires. The 88% is not just a number, it is a destination, and the strategies I just gave you are the directions to get there. I will see you in the next one.